I'll go outside, Mike, then. Oh, clubs are great. Hi everyone, thanks for having us. We've only got, well, it's 2 slides, but I don't think we can bother to flip these for the second one. My name is Lewis. I'm the head of intellectual property at representation at Lockton. Lockton is an insurance broker, so starting off on a high, also a lawyer by background, and we generally work on the mergers and acquisition space. So it's slightly on the glamorous end of the investment cycle when you're looking for sale of your games business and you've got a private equity or corporate buyer. Richard's an M&A lawyer will be involved, and what we essentially do is we insure the transaction. So it's behind the scenes these days, all transactions are pretty much insured. So we get to see all the dirty laundry and help find a place to put it. Probably think this topic is pretty important right now. Whilst Richard and I focus on the entertainment sector, our businesses both focus on lots of other sectors where there's just quite difficult funding investment environments. It's not just this sector. So there's quite a lot of lessons that we can learn from across the piece. But also, we're both in the middle of processing at the minute, which are quite interesting and have some kind of maybe useful insights that we can bring out. Richard, who are you? Why are we here?
Thanks, Liz. Hi everyone, I'm Richard Thickney. I'm Senior Counsel at Taylor Wessing. Taylor Wessing is an international law firm focused on the technology sector. We have offices throughout Europe, Asia and San Francisco. And really we specialise in helping fast growth tech companies scale up, raise financing, grow their business and eventually execute that M&A sale and make the founders pretty wealthy. Lifecycle advisors throughout that process. Cover the full range of technology sector, but with a particular focus as Lewis already suggested in games. So I'm an M&A and venture capital lawyer, help companies raise financing and then do their eventual exit. I think we really wanted to have this be a kind of fireside chat or discussion chat, and welcome contributions from you guys as well with questions. Really I think the idea for the session today came out of just conversations Lewis and I have been having recently. We work together quite a lot in this space around the state of the industry and really what's going on at the moment. I think it's fair to say it's been pretty interesting 4 or 5 years for the industry. Really significant growth, runaway growth in 2019, 2020, 2021, where we just saw massive amounts of capital flooding into the industry, real growth in revenues, and it was almost like a fairy tale. And then things started to change back into 22, into 23, the last 18 months. I think everyone in this room is probably well aware of how difficult that's been, both from a fundraising environment perspective, plus just growing revenues and keeping the lights on. And it's in that context of this challenging environment, what does it mean to raise financing? What does it mean to get exit away? And how challenging that can be, what the deals that are happening, what kind of terms are we seeing that are more on the buyer-friendly side? And if you're on the company founder side, how do you navigate that successfully? Because fewer deals are happening, fewer fundraisers are happening, that's for sure, but there are still deals happening. And when they do, how can you best navigate them? That was the thought process for today's session.
Yeah, and 2021, 2022, from the deal kind of advisor perspective, was just a weird period, wasn't it? Because they're actually in the market ran out of lawyers, which was you'd never if people screaming for more lawyers, but actually ran out.
Shakespeare said clone moment.
They actually ran out of a lot of advisors, actually ran out of insurance, if you believe that such a concept exists. And from my experience of that period of time, especially with video game transactions, it felt like there was just such a scramble for assets, regardless of what they were. And that environment has changed quite considerably in sort of the buyer mindset from what we're seeing, what you're seeing as well. I guess some people might call it a course correction, and we might be coming on out the other side of that. From investors and sort of people you're working with at the minute, what are they currently focusing on in deals? What's making them most buyers? How they come to me, and what's putting them off?
I think, as I was saying, there's definitely fewer deals happening. and the deals that are happening are taking longer to happen. They're much more intensely negotiated. Buyers are much more hesitant now to deploy capital into the sector. I mean, just taking a step back, I think, you know, we have seen amazing amounts of capital flood into games, the global industry, and especially in the UK over the last 3-4 years. And I think there's been a sense from the investor side that perhaps too much capital is flooded into the market versus what the size of the opportunity is. You know, the macro position has changed. We've seen IDFA changes in mobile are causing user acquisition problems. Business model is more difficult. It's definitely an interesting time on the investor buy side. I think for the deals that are happening, price is a big point. I think valuations have come down. During 2021, you were looking at valuations sometimes of 10-12x your earnings for a year. That's not happening anymore. The deals that are happening are much closer to, I think, 3-4 times. And that creates an issue that we're seeing in the deals that are happening, because you have a disconnect, a valuation gap between what companies think they're worth, what they've raised in their last round. If they sell for 3x, their last investor's going to lose money. That makes it harder to do the exit. So you're seeing this gap between what buyers are willing to pay or what they think a company's worth versus what the company thinks they're worth. And one of the ways we're seeing investors and buyers bridge that gap is to what we call earnout, or deferred consideration. That's essentially buyers saying to the founder team of the company, like, you say you're worth X, you know, we think you're worth X minus Y or whatever. But if you in the next 3 years can hit these targets, you know, we'll pay you X, but we're only going to pay you this amount up front, and then you have to earn out the rest. Now, that can be used to bridge that valuation gap, and from a seller perspective, I think, great, I'm going to get that money anyway. That's great, I'll take that. But on the founder side, there are issues to think through with that, which means those earnouts quite complicated. One thing I always say to my clients when they're thinking about this is, an earnout, you know, they do get paid, but often they won't, and often they'll be subject to dispute. So when you're approaching these things, if you have term sheet for an exit, first thing I would say is get proper advisors. But of course I would say that. These things are complicated and they will help you through it. But one thing, especially on an earnout, to be aware of is, I think, great to have the earnout, but treat it as a bonus and be comfortable with whatever the upfront payment is going to be. So I think that's one of the key things we're seeing buyers looking at is around pricing and how they can bridge that gap.
Do you think from a seller's perspective, it's a bit of a con? So I guess I'd only really come across earnouts really in sectors where it's highly experimental technology, where it's unproven, untested, and a buyer's looking at the target business going, well, if that works, it could be valuable, but no one can really tell. So we'll have a small upfront consideration, we'll have then milestones, and maybe if you achieve those targets, we'll put an earnout on as well. But I guess the video game sector is not like that, so that it starts to feel like a bit of a con just to get a cheaper asset in a difficult environment, or is it a really good strategy for sellers to get such a thing?
I mean, con's a bit strong. I think the challenge really is that, you know, there is a disconnect between what founders think their company is worth and what the founders have a clear idea of what their company is, what they're building, what their vision is, what they think it can be worth. And buyers are much more driven by the financial metrics and the wider macro environment, right? They just can't deploy capital at the same rates or the same multiples that they previously were. So if you want a deal to happen, you have to square that circle in some way. And the response from the investor or the buyer is always, like, if you think you're worth this, you think that's what you're going to be worth in 3 years' time, you should be happy to throw it out, because you'll be able to achieve it. It's quite difficult to respond to that and say, well, I don't think we need an earthquake. I think the types of deals where you see earnouts happening are where you have a fast-growing business where the value right now is not necessarily what the company's going to be worth in 6 months, 12 months' time, and you want to try and capture some of that. Or it's where the business is more volatile, right? And I think in a lot of games businesses, you can see that being the case, that they'll be doing really well now. They have got out a couple of games and they'll be generating that revenue, but the life cycle of that game might fall off. And where's the future growth of the company coming from? So buyers are very alive to that. They're not just trying to buy your current revenue. They're trying to think about what revenue is going to be like in 12 months, 24 months time. So I think it's very rare, I think, in the game sector to get away from a deal that has no competitor in it, I would say.
So once the sellers are looking to get an offer which they accept and they've got the letter of intent, the process then shifts to negotiation of the share purchase agreement. And as you said, the process now is not what it was a couple of years ago. It's pretty torturous in the minute. Things are taking months and months, and we've worked on processes in the minute which maybe 2 years ago might have taken a couple of months, but are now taking 9 months or longer, as the buyer's just scraping through every single bit of the business, just trying to find reasons to chip price or pull things apart. And what they're negotiating on the warranty and indemnities, just for people might be forgetting what those actually are in an agreement, but just for a refresher of what are they and why they get so heavily negotiated, especially now.
Yeah, I completely agree with that, Liz. I think it's a risk-based thing. I mean, buying a company from a buyer perspective is always risky. You don't know what's in it. You don't know what's wrong with the company, what's right with the company, what's going to happen in the future. And it's very completely incumbent on the buyer to do their diligence and figure that out and review the company's documentation, review everything about the company, try to build a picture of what the risk is. And it's a normal process in an M&A deal that they will try and bring the sell side into that process, and you have them share some of the risk. Like, one way they do that is by requiring the sellers to provide what we call warranties. Now, they're essentially just a series of statements that you provide in the sale document that says XYZ company is true. And if that turns out not to be true, then whatever they've paid you on the consideration, they can try and claw some of that back to your warranty claims. So they're essentially trying to share the risk with you, and then as a seller, you have to tell them all this stuff where it's not true, so that you can protect yourself. And that process is now becoming much more involved, and the warranty packages, the liability attached to it is becoming more involved, because this is a risk-off environment where it's harder for buyers to get comfortable with doing deals, so they are trying to share more of that with the seller side, whereas previously that just wasn't the case. And that can create tensions where it makes deals harder to get done, particularly where we have certain buyer dynamics. Like, for example, if you're trying to sell to a US buyer, they have a very specific approach to taking warranties and indemnities on deals, the level of liability that they're looking to have what sellers stand behind for X number of years after your deal is closed, and that can be quite difficult to get the full seller side, everyone on your cap table to agree to, particularly if you've got financial investment from a venture capital fund. They just won't provide those warranties. So that can be a catch-22, right? How do we solve this and have this not cause a block on the deal? I think that's where you and I have actually been working together most frequently, because that is where insurance can come in and really help unlock those deals, where you see no one really wants to take this risk on a buy side or a sell side. And in a different market where buyers were desperate to take the assets, the buyers might just suck it up. But that's increasingly not the case. So I think insurance is coming in to help unlock those deals.
Yeah, I guess that might also play into the fact because the valuations are so low, or not so low, they're lower than what people's expectations would have been. And so then when there are things coming out of process of due diligence and negotiation, there's not really any room left as let's push down valuation further. So if the buyer's unhappy with the business, the risk's in there, it's got to go somewhere. So that's where
sometimes businesses are being sold really, really cheap.
Yeah.
Because it's almost, we've all seen the number of studio closures, the number of layoffs that are happening. Like, it can often be better to have an M&A deal or an MBO where the founder team buys back the business for a nominal amount, maybe with some capital left in the company to run it for a period of time, so that the business has a chance to another life, and all those jobs aren't immediately lost, versus the opposite, where the business is just going to be shut down. I mean, I've seen those deals happen. In that scenario, the seller who's basically giving away a business are not going to be providing any warranties, right? They're not going to be providing any ongoing liability attached to that company. So, but you still get warranties still need to happen. So how do you deal with that? And that is where we've seen insurance really unlock that and make deals happen.
So where we're seeing that more and more is because I'd say it's probably a 70-30 split. 70% we work with private equity, 30% is corporates. But we're seeing private equity make a bit more of a march on the interactive entertainment space, so that we can see they've been waiting in the wings, sniffing out bargains, and they're now buying up distressed or distressed studios or assets because they're seeing there's potential there to smash different studios together, maybe, and chase for economies of scale, etc. But because they've got to justify to their investment committees taking on this risk, which they're not necessarily familiar with, they'll try use insurance to push the risk out of the deal onto the insurer. So what this normally means is that the seller walks away with the liability. That's the goal. So if it's a distressed deal, it's slightly different. But if it's a normal transaction, normally now sellers' lawyers will try and get their client position to the games company where they basically just walk away with £1 liability, and then there's very little risk left to the management as they cross over. And the reason for that is partly, I guess, the sellers want that. They want to walk forwards, not focusing on target on their back. And the buyers want engaged creators, so after the process is finished, focusing forward, not thinking of what we've just got this great deal, but we've got to sit all that cash somewhere because we're worried about claims coming back.
This point on incentivization and keeping management engaged is crucial, right? And it comes back to the earn-out piece as well. These games industry is creative business, all right? And the value is very much driven by the management, by the core people who are actually creating the product, who are driving the strategy. They are the value. Like, a games business is people and it's IP, right? Keeping the team engaged and really passionate about the company and growing the business is fundamental to the value. So 2 points. That's where buyers will also use an earn-out, because they'll say, look, you can get X amount up front, but it can't be life-changing amount of money because we want you to stay around for the next 3-4 years and build even more value. So you can have this amount up front, but the real value is going to come in the earn-out, and we want you to drive that growth. And that, particularly in the good times, we were still seeing earn-outs on that basis, because you want to lock people in is a negative way of looking at it, but just align the interest between the buyer and the management team. And similarly on the warranty side, it's hard to be focused on building the company when you're worried that this parent that's just bought you could be coming after you for a warranty claim for hundreds of thousands and millions of dollars. So being able to say to a founder team, look, here's your earn-out, but also here's a £1 liability cap on the warranties. We're not going to bring any claims against you, and we're just going to off-balance sheet that with an insurance policy. And that's an ideal position from both a sell-side perspective and what I always try and push my founder management team clients to push for. And from a buyer perspective, it makes sense, right? Because they're incentivizing the team to build value.
Yeah, I guess there's obviously we're day-to-day focusing on the legal aspects, but it's amazing how much of this is all emotional, isn't it? It's all emotionally driven.
100%.
So
it's a people business.
Yeah.
So you're investing in the creatives, you're investing in the management team, and you need to structure the deals in that knowledge.
So one thing that I've noticed, and I guess this will be reflected on your side, is that we're seeing buyers now, even because they've got fewer processes, and that's partly driving this, doing a lot more due diligence on the companies they're acquiring, and that's no different in the game sector. So whereas before they might sort of do quite a light scope on the business, get comfortable with financials and the tax position, and just kick the tires generally, finding now that there's a lot more detail that's going into the due diligence process. And I guess, as might be the case in a lot of creative industries, there's maybe a slight rush to focus on the product, and sort of the management process is sort of secondary, and that starts to come out in the due diligence process, and the buyers start to unpack things and find problems, which could be a liability they bring on. So what we've noticed recently is a lot more pushing on specific indemnities. Maybe you can just explain a bit more about that, but on things like regulatory exposures, that's becoming a bit of an issue we're seeing. tax, so we see a lot of share incentive schemes going a bit wrong. So,
You've not mentioned the big one yet. That's particularly problematic in games.
Oh, I forgot.
The big buzzword at the moment, artificial intelligence.
Oh yeah, sorry, yeah. Well, it's too obvious to mention. So we actually sort of got a process on the go at the minute, which is it's alarming, but it's a sign of the time to come, I think, which is it's a well-known corporate that's buying a company which it's a vertical integration, so it's got technology play, it should work with the buyers group and enable them to do things they couldn't do. And I think we'll see this in the video game space a lot more, where the use of Gen AI starts to kind of change business models. But in this case, sellers management had made quite bold statements about what their technology was doing. So they were adamant that the initial negotiation stage that everything they were doing was pretty much powered by Gen AI. It was going to enable massive efficiencies in the processes for them and the buyer group. Offer was put down when they started to get into the process of unpacking that. It was such a bait and switch. It was basically, what it turned out was about 900 people in a country which the buyer was thinking, well, we're getting to that territory, manually doing a lot of stuff, and then basically.
So it wasn't even white label ChatGPT. It was just all.
No, it was a complete bait and switch. But at that point, what we find is then some of these processes, the buyer is feeling a little bit sheepish, and that's sort of some cost fallacy. So to get to that point, they probably spent a few $100,000 on lawyers and advisors to work out what's going on with the deal. And they start then negotiating, pushing down, getting their heels dug in, and then start pulling more and more different threads until pretty much like this one, I'm pretty sure the whole thing's going to collapse. And I think it's a cautionary tale on sort of being careful, especially on the use of Gen AI, on what you're actually doing with it.
We're running short on time.
Yeah, not overselling it, because I think the due diligence process now makes it inescapable. These things get put in a context and pulled apart.
Yeah, I completely agree. We've run a bit short on time. I did want to ask if anyone had any questions, but I think we might not have time for that. So, if there are any burning questions, please do.
It's a quick question on at the moment with the current market. You mentioned 70% PE, 30% corporates, but from the acquisition target, if you're seeing any trends around work-for-hire outfits in the game sector, IP-rich companies, or in terms of number of IP, or a single big swing IP companies, and if you notice any change in dynamics in this current period versus before.
Jump into that. Just to clarify the question, is that you're asking what the kind of ideal target is right now?
Yeah.
I think, you've hit upon a couple of them right there. I think, depending on who your buyer is as well, right? I think what private equity is really interested in is work for hire. Private equity, the way they're set up, they need to have a company that has predictable revenue or stable revenue. So whether that's work for hire through contracted services that you have through you're working for a bigger publisher, and you're not really exposed to the creative audience risk, right? You've just got your contracted revenue. That's private equity loves that. Similarly, they love bigger games that have that are more like platforms that have recurring player bases that are just there constantly spending, because it looks more like a SaaS model, right, for them. So that's the private equity needs that. I think if you're selling to the other thing that's still, I think, quite attractive is if you're a business that has a portfolio of games that are performing well, particularly in the mobile space. I think there are still buyers for those. Scopely's a big one, Tencent's a big one. Zynga. These buyers are still out there, because the challenge in the market right now is that creative content challenge of it can still be a hits-driven business, right? So you sink your capital and you take a risk. And where M&A can help the bigger players is they allow the little guy to take the risk, and once you've demonstrated market fit and you've found your audience and this game is stable, you've got a portfolio of stable games, then they're just buying revenue. Then they're like, there's a market, there's an audience for this, we will add it to our portfolio, and then the founder team that built that smaller company, it's a great payday for them. So I think those deals can still happen, but it's just a harder market.